Hey guys, a very, very, very warm welcome to yet another interesting episode of the Fisdom Wealthcast. So we have come back after quite some time, and I strongly believe there was no better time than now to bring the most incisive insights on the most pressing topics that investors and every other market participant is facing today, right? And today, for this special episode, we have a very, very special guest. So, for today's episode, Aashish Sommaiyaa, the CEO of WhiteOak Capital Mutual Fund, has been kind enough to join us for this conversation and share his perspectives. I'm sure each one of you would already know Ashish by now. He's a name that needs no introduction. He's been around in the industry managing assets for over a quarter of a century. 25 years plus now as we speak, and over a decade, well over a decade in leadership positions. So, on that note, I'd like to very, very warmly welcome Ashish to the conversation. Hi, Ashish. Welcome to the Fisdom Wealthcast. Always such a pleasure having you on call. Ashish, you're on mute.
Thank you, Nirav. Thanks for inviting me. Thank you very much.
So, Ashish, bhai, one quintessential question every season of the time, everyone asks me the same question, and I'm going to ask you the same one. Market kya bolta hai? So, for a long time, it has been a roller coaster ride, but then again, for a very long time, it's just a one-way slide, a huge, humongous slide, at a very fast pace. So,
Yeah.
what's your perspective and your reading on the overall market situation? आपके हिसाब से market क्या बोलता है?
So, I'm going to use a cliche, एक cliche होता है, cliche जिसको बोलते हैं कि it will get worse before it gets better. But so the not so great thing is that it could get worse, and the positive thing is that it will definitely get much better. Now, the timelines is what matters because, if you really ask me, just to, of course, I need to elaborate on that for our listeners. Why did I say that? See, every year, first of all, two, three things to keep in mind. Practically every year, from the highest point, once the market declines 15-20%. It happens practically every year. Even today, for example, if you go back in time, say June 4th, 2024 was the low point. Before that, this Israel and Hamas, whatever happened, October 2023 was 17,700. Before that, when Silicon Valley Bank, we all got educated about the existence of a Silicon Valley Bank in March 2023, Nifty was 16,600. In May 2022 or June 2022, when everybody was expecting Third World War and oil was $129, that time Nifty was 15,200. So, and you know that from each of the points, the highest was different. Like market has been, so practically every few months or every year from the high point, market does decline 15-20%. And every time the reasons are different for the decline. Right. I gave you reasons myself just now. Yeah. In 2022, people thought that Ukraine will blow up into a third world war. In 2023, people thought that Silicon Valley Bank will become more like Lehman crisis. In end 2023, when Israel Hamas happened, people thought that okay, US on one side, Russia on the other side, this will again, degenerate. And nowadays people are thinking that all the FIs will just go away, and India was overhyped. All those. So what happens first is that there is a point in time when there is a big rally in the market or a movement in the market. Ultimately, market will get stretched, and for any one or the other reason, there will be a correction. And corrections are par for course. And Fisdom and yourself, you are from the tech world, and in the tech world, very often for certain phenomena, you say it's a feature, not a bug. So,
Yes.
in the market also, corrections, they are a feature, not a bug. Now, for the current episode of market fall, we should go back and see that, we peaked in September and the market troubles started in October. So initially, for some time, people were saying that, okay, money is going into China, blah, 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 all these things you started hearing. And then, very quickly, it went into being a Trump trade, you know, uh, US, largest economy in the world, largest stock market. It gets a right-wing, business-friendly president who says, we'll make America great again. We will get all the, reshoring. We'll get the factories back, and we will cut taxes, and so many things people spoke about. So obviously there was again, and plus US has been on a tear from last 3-4 years because OpenAI, ChatGPT, the moment it came up, there has been a whole AI driven upsurge. So AI driven rally plus Trump trade. Now, if you see, broader US market was pointing to a slowdown, whereas the top seven stocks of US is what has been driving it up. And US became 68% of total market cap of the world, and the top seven stocks became 18% or 17% of the total market cap of the world. So, look, if the US is pulling so much money, obviously emerging markets they will face a relative depreciation of currency, they will face outflows, and they will face a downdraft in their markets. Correct. This is what has been happening, and by the way, this is happening for 3 years. India was a rank outperformer. We didn't realize because our currency was stable. In our market there was some sector rotation, some did well, some did badly, but net net our market went up. In last year or two we have gone from 19,000 all the way to 26,000 at the highest point. Correct. So we have seen relative outperformance and we have seen relatively stable currency. So we didn't realize, but emerging markets have been in the same spot. Now we have caught up with other emerging markets only in the last 5-6 months because all of this got compounded with some slowdown at our end. But the core point is that our troubles and emerging market troubles, they started with a rally in the US market. So if US is, in dollar terms, if US keeps delivering 10-12%, then obviously emerging markets will face a challenge. Except that India didn't face too much of a challenge because India relative performance was very, very strong. Now we have caught up with the other emerging markets. Correct. Now we have caught up with other emerging markets. So from here on, why did I say it gets worse before it gets better, and why did I say it will get better? Basically, what I'm alluding to is that if you see last 15 days, you can see that the US market is giving up its strength. Nasdaq is down some 10-12% from its peak. As far as AI is concerned, people are not using the word bubble, but people have started using the word hype. And the AI, all these big companies investing 80 or 100 billion dollars a year for augmenting AI capacity, they think AI is all about buying faster chips, setting up data centers and power generation plants. We don't know the winners of AI, but everybody has decided that they want to be the winner and put 80 billion, 100 billion worth of capital investment every year. Now people have started questioning that what is the real end use case. I was watching a podcast of Satya Nadella, and he, in not very direct terms, but he basically said that we'll have to watch for end users and we'll have to watch for customer interest, and then we'll have to plan. So they have started, backtracking on data center leases, and they have started, reducing the pace of spend, etc. The other important thing is that Mr. Trump and Mr. Musk's policies, if you cut, हमारे यहाँ पे 6 months the government didn't spend, we had a slowdown. For a country of US size, if they say we will cut spending by 2 trillion, what kind of slowdown it will bring about? Correct. Plus all the disturbances because of a trade war and the threat of tariffs. So long story short, I think the US market has gone on for too long. It has started to give up its strength. If the US markets start declining in sympathy, we will see some further decline. But that will be the good news because a US market decline will be followed by a currency or a dollar weakening, and it will be followed by softer interest rates. And ultimately, that will result in reallocation of flows into emerging markets. So my sense is that another 2-3 months we have to watch for US to correct. We have to watch for US interest rates and US dollar to go down, and that will result in significant reallocation of flows to emerging markets. And we will stop watching for the FI number every evening. This is just for another month or two. I think, long story short, we are in March 2025. If we speak in, if we, next month or two, let the market bottom out. I don't know where it will bottom out. But if we speak 1 year later, we will be in a much happier situation. And maybe you will have
So,
significant upside, actually, good double-digit returns.
oh, that is so heartening to hear, especially after the past, almost 2 quarters now that the markets have been embroiled in just so much pressure. Life has been seeming difficult. I feel one very good bottom line is something that you started with. It is going to get worse before it gets better. I feel at this point it is more of a question of when and not as much of an if. It's not whether Indian markets are going to recover. It's just a timeline thing. We may have to wait longer than initially anticipated. Also, towards the end, we briefly touched upon this entire FII outflow and FIIs coming back in, right? So probably, if we could just double click on that, just zoom in on the entire FII phenomena, because a
Yeah.
lot of fear, a lot of panic is also coming from the fact that FIIs have been selling left, right, center. In fact, there is speculation going on. Is this a call against India? पैसा जा कहाँ रहा है इंडिया से like is it a sell India sort of a call? What's your take on this entire FII outflow saga?
So I want to share a few details with you, and then at the point in time, when I want to put up a slide, I'll call out. But right now, just to answer your question, before I get to the slides or before I get to the data, I just want to clarify a couple of things for the benefit of all our viewers. Uh, First of all, it's not that FIIs wake up in the morning saying India is bad, let's get out. See, we should understand one thing. And okay, let me just put up the slide now. So if you allow me, and you need
Yes.
to make it arrange to kind of broadcast this. So you can see this, Nirav. There is a slide. FIIs. Who are they?
Just a second, I guess the slide is, yes, we can see it.
Yeah. So Nirav, here, see what it says is that there's a pie chart out here, and it's basically pointing you out to what is the source of all this FII money. Like what are we talking about when we say FII? What exactly are we really talking about? Now, when we talk about FII, so see, there could be sovereign wealth funds. Okay, that's an example. Then there are four different parts. See, it says India dedicated passive funds. That's only 3%. There is India dedicated active funds. Like WhiteOak is one of the largest FIIs, and WhiteOak falls in this bucket. We are largely speaking an India dedicated active fund manager, and we manage about $6 billion for foreigners investing in India. Then there is something called non-dedicated. Now you see, Nirav, that the two biggest animals on this are non-dedicated. When this is prefixed by non-dedicated, you know what it means? It means that this is money not deliberately or directly coming to India. This is money which is part of some basket. And more often than not, what is this basket? This basket is, say, global emerging markets or global equity. So what happens is that some rich man or woman sitting in Switzerland or Europe somewhere or Middle East or anywhere in the world decides to put money in emerging markets. For far too long, people have been doing this basket kind of investing because they are not discerning enough to say I want to buy India or Vietnam. They, for some odd reason, that's been the pattern that they think that they have to buy a basket which is called emerging market. Now, if you put $100 in this emerging market basket, willy-nilly, some money would go to India, China, Eastern Europe, Latin America, South Asia, and Taiwan and South Korea and all of these places. And if you put $100, some $15, $17 would come into India. And then there are funds who would be overweight and there are funds who would be underweight. But you can imagine that for every $100 that somebody puts in an emerging market bucket, some $15, $20 would end up coming into India. Now, what has happened is, like I said, last 3 to 4 years, India has been a rank outperformer. But that's not true for the whole basket of emerging market. You know that in 2021 end, China started, throwing out all these tech companies. They had a zero COVID policy. Their real estate went through a trouble. Their banks had NPAs, and their president wanted a third term, so there was a lot of repression. So, long story short, China, which was the largest component, barring the last 6 months, China has been a rank underperformer. So, if you look at emerging market as a basket, the 1,000-pound gorilla was China, and they had disastrous performance. Then Russia got thrown out of the market itself. Then there is Taiwan. If Chinese fighter jets are, buzzing over Taiwan, you don't expect Taiwan to do much. You'll expect the market to do badly. And then there is also assortment of Latin America and, Turkey and Argentina and Brazil all having their own political challenges. So long story short, emerging market as a basket wasn't doing well. And then US interest rates and US AI and all these things. So US kept doing well and good part of emerging market basket kept doing badly. And India was the outperformer. Now the point is that you may be an outperformer, but if somebody removes $100 from the emerging market basket, तो लेना नहीं देना तुम्हारा भी $15-20 जाएगा, right? So bulk of the FII outflow in India in last 3 to 4 years has been emerging market basket related outflow. There may have been some outflow from India which is India specific, but that may be last 3-4 months. Otherwise, if you generalize for the last 3-4 years, the outflow was more emerging market basket related outflow, not India dedicated outflow. In fact, 3 years back, I distinctly remember these non-dedicated active funds was 77%. And this India dedicated active funds was a very tiny number, which has gone to nearly 8%. WhiteOak is an example of this. In the last 3 to 4 years, we have gone from some 2.5-3 billion all the way to 6 billion, right? So on your question, what I want to tell you is that the outflow is emerging market basket related, but not necessarily India related in the last 3-4 years. Further, when I was talking about the FII part of it, you can see this slide, Nirav, it says FII flow relative data.
Yes.
Now here what we have done is that we have marked out all the periods when India has had a significant FII flow, and barring one or two, barring this NBFC crisis and barring this particular slowdown, all the instances of FII outflow in India have been related to global reasons or have been related to global phenomena, right? Like this is Lehman crisis, this is US credit downgrade, all of these. Now what you will notice is, first of all, today there is a lot of noise about 24 billion nikal gaya.
Correct.
But see, you have to see this in light of the market cap. If I tell you that I had 100 crore outflow, is it a big number or a small number? You can't answer that question. If my fund is 1 lakh crores, then 100 crore is less than the daily inflow outflow. But if my fund is 500 crores, then 100 crores is a big outflow.
Yes.
So in Lehman crisis, 15 billion went out, but that was when our market cap was 1 trillion. So it was 1.5% of market cap which went out. Today, 20 billion has gone out, but average market cap in this period has been 4.5 trillion. So what has gone out is only 0.6%. That is first thing I want you to take note of. The second thing you take note of, whenever there is big FII outflow for reasons other than our domestic reasons. See, this NBFC crisis, this was ILFS default.
Correct.
And this was an economic slowdown. In both of these cases, we had some minor FII outflow. The market declined not much, 8% and 10%. And then 12 months subsequently, the market kind of went up 15% and 10%. You ignore these two instances. You focus on all the other instances where the outflow is for global reasons. Whenever the outflow is for global reasons, the market falls more, right? And then you see 12 months from the trough, what kind of up move you are seeing here.
Correct.
Right? So what we should keep in mind is that I don't know where the market will bottom out, but the entire outflow is not attributable to India specific reasons. And second is, wherever it bottoms out, because the outflow is not India specific reasons, when the people are selling for global reasons, we should not participate in that selling. Basically, when the selling subsides, when the market recovers, you are likely to see a significant upside. So it's better to, stay put. And, a lot of people say that you must have heard Warren Buffett is quoted ad nauseum, be greedy when others are fearful, be fearful when others are greedy. I always urge people to think, who is the others?
Correct.
The others. This is your opportunity not to be the others, right?
Absolutely.
See, if I ask people today, in March 2020, what you should have done, they'll say, I should have bought. In June 2022, missed opportunity. March 2023, missed opportunity. October 2023, missed opportunity. So 1 year later, what are you going to say about March 2025?
Correct.
So that's the thing, market fall. Every year the market falls. Every year the reasons are different. The question is, are you part of the others or are you outside of the others?
Absolutely. I feel this gave a lot of perspective. In fact, I personally loved the entire attribution pie where we finally got to understand ये पैसा कहाँ से आ रहा है, ये FII है कौन, right? There's this question about FII selling, and I feel this entire concept of basket selling puts a whole lot into perspective, right? Because India is a part of a larger emerging market basket. But Ashish, also on that point, there is a very intuitive question that comes as a follow-up. तो अगर बास्केट के चक्कर में इंडिया भी बिक जा रहा है, right? If people are trying to sell the entire basket and by virtue of that they're selling India, are we necessarily going to wait for a basket buying to happen for interest in India to develop? Is that the situation, or how does the case change when we say that FIs will probably come back sooner to India? How do we interpret that?
No, see, one change which is happening is that instead of basket, you are seeing that slowly India is becoming like a one of the important single country allocations, right? Uh, so even in the last couple of years, there has been a few percentage points reallocation where the proportion of money coming from baskets is going down, and the proportion of money coming deliberately seeking out India is going up. The rise of managers like us, who are large India dedicated managers, managing global money. So in 2020, WhiteOak was managing $1.5 billion for foreigners. Today we are managing 6 billion. And this is India. We have emerging market, but just India dedicated for foreigners is 6 billion. So what I would say is that the proportion of money coming to India from baskets is going out. There is some disenchantment with these baskets because the baskets is just a motley, assemblage of multiple things. It's not making much sense in terms of correlation, lack of correlation, or diversification, blah blah blah. So there is some disenchantment with the basket thing, and money is coming more deliberately to India, but it takes time for that reallocation to happen. But you will
Correct.
see that next time I present to you, instead of 7.7, it might be 8.7 or 9. And it's not a small number.
Oh yes.
Every percentage is few $billion.
Correct. And also, you also made the point in the case of WhiteOak itself, you saw it 2x, right? You saw it double up in a matter of
Yeah,
3
and
years.
to be fair, in
Completely.
India, there are other managers also. I should be fair. So there is Kotak, there is UTI. They
Correct.
also manage sizable money for foreigners, and they are also India specialists. So all of
Correct.
us have seen, like we may have grown faster, but all of us have seen that shift.
Correct, correct. I feel this is something that will extrapolate into the future. It also makes sense to move away from a basket style. But I feel this entire conversation around FIIs and basket investing will be sort of incomplete if we do not pay tribute to our best topic of markets today, that is Trump, right? So with this Trump administration coming in, and I don't know, personally, I don't have a lot of view on what his policies are going to look like, because it really depends on which side of the bed does he wake up from it at this point in time, right? And with Mr. Musk also as a key advisor, it is becoming incrementally difficult to make any predictions around the nature of policy. At least the last time around, he was very vocal with his tariffs and what was he against. But this time around, Trump has listed out a variety of measures that he is also actively rolling back in real time as we speak, right? So there's a lot of indecisiveness there that is also spilling over into the nervousness that we're witnessing in domestic markets. So what's your view on this entire Trump administration thing, and this entire talks around tariff and trade wars, and how does it augur for India in the larger scheme of things?
Yeah, so difficult for me. Even I can't claim to be. see, see that one of the challenges with a lot of this is that you can't be knowledgeable enough about these subjects or these topics. Not presenting that as an excuse, but the point is, it is ultimately one person who's setting the agenda. See, it's not like there was a it's not like there was a vision document that was laid out in front of us, which we could have spent enough time reading and researching. And it's not like there are some past policies or trends which are being extrapolated.
Correct.
It's like, somebody has a very important person, very influential person for the globe has come on the scene, and he has started to. Yes, of course, he gave us a glimpse in 2016, 2017 when he was the president. But I don't think anybody can claim to be knowledgeable enough about this. But there are few things one can say, just observation or just reading up. See, one example is that you can see that the world is going from being multilateral to being bilateral.
Yes.
See, for about 70, 80 years post the World War, post the Second World War, there was like a global order, right? And US being the largest economy in the world, being the superpower, the US consumer has been the most influential. A lot of things thrive on the US consumer, and a lot of things thrive on the US armed forces, especially the US Navy, because like there are oil tankers, and there are electronic gadgets, and there is textiles, and there is food stuff which is floating on the high seas without being attacked. Like if there is no Indian Navy in the Indian Ocean, or if there is no US Navy in various parts of the world, then all of this will not be happening. So the US has armed forces, in NATO, in European countries, in Qatar, in the say Japanese side, right? In Asia, on the high seas. So they have naval bases all over, right? They have naval bases all over. They are in some sense maintaining the world peace and the world order, right? Now, till it suited them, it was great. But what is Mr. Trump saying? That for far too long, the US consumer has been priming the economy first for Japan and then for China and now for other Asian countries. So he's saying that why is the US consumer taken up the responsibility of helping all of these guys fill their pockets by exporting to us? And why is the US taxpayer bearing the bill? See, what is the confrontation with Europe about? That boss, I think NATO spends some 800-900 million. I don't know exact numbers, some 800 or 900 billion a year. US spends 600-700 billion, whereas all European countries put together spend 200 billion. That is why he said, right, that we have a whole ocean in between. Why the hell are we fighting your battle? Correct. So till the time it suited them and till the time they were the big brother, it worked. But now Mr. Trump thinks that all this is not working. We are paying the bill. And plus, of course, demographics change, financial conditions of people change, politics changes. So what they were doing for last 40, 50 years, they decided it doesn't work for us anymore. You guys need to pay us for it. So how do you pay the US consumer? I make it difficult for you to sell. So I insist that you manufacture in America. If you don't manufacture in America, I insist on charging you tariffs, right? So I insist on hurting you. In the process, it may increase inflation and hurt US consumer, and all that is second order effect, but that is what he's saying. And second, he's saying that if you want the US armed forces, you better pay up. Correct? So even to Ukraine, he's saying that if you want me to ensure peace for you, you better supply, give me mineral mining contracts, right? So, when we were in school and college, there were reams and reams of paper about World Trade Organization and, International Monetary Fund and all these, multilateral institutions. I mean, itna sara kaand ho gaya, there is no discussion. There is no such institution. Nobody's even uttered United Nations from their mouth in the last few months. So you can see that it is all becoming bilateral as compared to a multilateral this thing in the past. Now, in this whole bilateral thing, that's why Mr. Modi has landed up in US and Mr. Jaishankar is saying we are willing to negotiate this and negotiate that. And, he said, what BRICS currency? There's no BRICS currency. We are not even on the table, right? So, like, basically, he was telling the US administration, don't paint us with China and South Africa and all those. There is no BRICS currency. It's right? So, it's all give and take. You scratch my back. So, suddenly we are saying imported electric cars, 15%. Acha, wo nahi chahiye, chalo, wo bhi nahi hai. So, things are changing, and I think we are well positioned. See, because ultimately we will be the biggest consumer market and the biggest labor market, and all the things you mentioned about tariff, maybe I have digressed a bit, but basically what I was trying to tell you is that tariff is just a gun. I mean, I'm showing you a gun, and the gun is useful. The gun is useful if I don't have to shoot. Yeah. So obviously he's a great man. He also understands all this. Above our pay grade to comment too much, but I think the tariff is just a gun. It's just a negotiating tactic. Basically, the world is moving to more, give and take. So we have to see how things, a lot of things are thrown up in the air. We have to see how the chips fall. But I think we are not badly positioned, if you really ask me.
Correct. In fact, this brings us closer to home, India conversation on how are we positioned. There's this entire conversation about अभी in hindsight सभी बोल रहे overvalued तो हो गया था ये तो बहुत जरूरी सा था healthy correction. And now finally in hindsight all these words of wisdom are pouring from all corners of the market. But there's also a strong undercurrent of narrative that's going in line of India still continues to be a very fundamentally strong economy, and macroeconomic tailwinds will continue to drive the next leg of growth in equities, of course, after this healthy bout of correction. So probably a twofold commentary from your end. One on the economic health of India, especially current, considering कि earning downgrades वगैरह भी काफी हो चुके हैं. There's also a lot that is well behind us in terms of inflation, currency risk, etc. So your commentary on the economic health of India, and probably if you could top it up with your comments on valuations at large.
Yeah, so Nirav, I think there was definitely concern. See, there are certain parts of the engine which have been growing and certain parts not so well. So you can see that private sector capex. See, there are multiple things, like there is government spending, there is private sector capex, then there is consumption, right? There is services, exports. So there are multiple legs to growth, correct? If you see in the recent times, high value consumption, urban consumption, discretionary consumption, post COVID, that is what was firing up, right? You could see automobiles, you could see real estate sales, a lot of these things. You could see, quick service restaurants. You could see eating outdoors, air traffic, hotels, tourism. You could see a lot of consumer discretionary stuff flying. You could also see government pushing capex, government investment into roads, railways, a larger number of airports, and so many of those things. But you kept hearing about rural consumption or lower end consumption not doing too well. You can also hear about private sector capex being very limited to few industries, like import substitution, export orientation, some amount of manufacturing, some amount of defense indigenization, electronics manufacturing, maybe a little bit auto ancillary, cement. So some areas you could hear of private sector capex, but otherwise you would see that private sector capex was not really firing up. Exports, of course, has been patchy. First it got hit by COVID, then there was a rebound, then there was oversupply, overstocking, then a normalization. So many things. So the point is that there are multiple engines to economic growth. And whenever you see 6.5% growth, means that all the engines are not firing. When you see 8-9%, meaning that some engines are firing a lot or all engines are firing. Now, in the last 6 months, what has happened? If you see, not last 6 months, the first 6 months of FY25, if you see first 6 months of FY25, what really happened? Pretty much the government was missing in action, because obviously in March we announced the election, then April and May elections were there, then June the result came, then government formation, then July the budget comes, and the government gets into action. So by then 6 months are over. So in the first 6 months, it's very simple. If I owe you money and if I delay the payment, the money is not with you, the money is with me, but it's very much in the banking system. But if the government has to spend and it stops spending, then the money is not in the system. The government collects taxes, they go into the government's account with RBI. So if the government collects revenue but fails to spend or fails to spend at a necessary pace, then it causes a crunch in the market. The second thing, what happened in October onwards, obviously that there was FII selling and there was outflow from the country. Now, when there is outflow from the country, somebody is selling rupees and buying dollars and repatriating it to their country. If you leave it to normal forces, people keep selling rupee, people keep buying dollar, the rupee keeps falling, the dollar keeps going up. Okay. But originally what RBI was doing was, they were supplying dollars and they were mopping up the rupees. They didn't leave it to market forces. They were intervening. So as a result, what happened? 60-70 billion dollars went out. And for all of that 60-70 billion, we actually mopped up rupees. So the liquidity in the system went down. So first 6 to 7 months or say 9 months of 2025 financial year, government spending was missing, which kind of engendered a slowdown. And RBI's intervention in the foreign currency market, it caused liquidity to get sucked out from the system. So short-term liquidity interbank liquidity was tight. If liquidity is tight, then you cannot create credit. Lending becomes difficult. So all of these things hurt us in the first 6 to 9 months. But see, as far as local conditions are concerned, now there is multiple things which have reversed. First, RBI stopped intervening. So rupee went from 84, 85, it went to about 88, and then it stopped. Now we are 87, 88, right? We stopped falling. Whatever little damage was to be done is done. Now there is not much of turbulence. And the dollar index has also come down all the way by some 5-6%. So that part is sorted. Then if you see RBI has started cutting rates and US market falling, US dollar falling, US yields falling, that gives us more space to cut rates. So RBI has reversed the liquidity. RBI started cutting rates. They are clearly indicating more rate cuts. Okay, government spending is back in full force. Government has presented a budget where they've reduced deficit, maintained capex, and given tax cuts. Every state election, we are throwing money. We announced 8th pay commission. These, 8th pay commission will get enacted next year, but will come with arrears. And past history shows that these pay commissions have big impact on consumer discretionary consumption and automobiles and stuff, right? And it's a big reset. Entire base of compensation for millions of central government and PSU employees just changes. And it comes with 1 year arrears. So what I feel is that a lot of the reasons for our slowdown are behind us. A lot of actions have been taken now to get growth and credit creation back and consumption back. So I think the worst for our performance at least is behind us. And it's not for me to say. You can see first 6 months GDP growth was 5.4. Next 3 months it is 6.4. The whole year GDP forecast has been revised up to 6.5. Correct? 6.5 is not great, but it basically means that good part of our country is still performing. And as far as sectors and stocks are concerned, there will always be something which is cheap, something which is expensive, something is outperforming, something underperforming. That's why you have portfolio managers. It's their job to pick what is relatively undervalued or what has more growth potential. That's par for course. That anyway we have to do. But I think as far as our domestic performance is concerned, the worst is behind us. You will see an improvement trend from here on.
So absolutely, I feel the worst, at least in terms of economic indicators, is behind us. Probably I was just reading a report on the total earning downgrades also that were expected. It is a large part of it is already done, right? But this also brings us to the second part of the question, and that is valuations. If we look at the headline indices very specifically, large cap, has also dipped below the long term. Average PE, and mid cap and small caps have only recently dipped below it, just barely dipped below it, right? Now, I'm not saying that long-term averages are any indicator that must be a North Star metric or anything of that sort, but at least an indicator of valuations at large, right? So, what is your perspectives on the valuations of the broader market? That's one. And second, I'd like for you to settle this debate on whether it is a good time to move completely out of small caps and in favor of large caps. The narrative is swinging in favor of large caps, but at the expense of small caps. So, what's your overall valuation outlook and the large cap versus small cap debate?
Yeah, so see on valuations, because you mentioned, I just putting up the screen, just
Yes.
bear with me. Now, there are a couple of slides. Can you see this, Nirav?
Just a minute. I think it's loading. Yes, we can see it. Valuation perspective.
Yeah. So see, this is what you are alluding to. Now, the 10-year average, this is 1 year forward consensus PE. Okay. And the blue line is the 10-year average. So the 10-year average has been 18 times forward.
Correct.
And now, like you rightly said, we are, this was 28th of February. So you are seeing that, in the first few days, we just dipped below average. So this is more, just as a corroboration of what you were saying. But, beyond just the PE of the market, even WhiteOak, for example, we manage these balance advantage funds, which based on valuations, they keep on rebalancing between debt and equity. You know how these balance advantage funds work, that when the market becomes expensive, we start trimming equity, and when the market becomes cheaper, we start increasing equity. So I would give more weightage to these, because these are not just PE multiple. This is indicators we have created with some research. Correct. So you can see clearly where it's coming now. See, if you this green line, whenever the market is above the green line, see the blue line is adjusted price to book. And what do we mean adjusted price to book? That is price to book adjusted for return on equity. See, generally when the return on equity is going up, you will tolerate a higher price to book.
Correct.
So if you see here, now the green line tells you the long period average, okay, 10-year rolling average. The blue line tells you where we are currently. So now on this, there is a sharp decline. So when it falls below is when it is attractive. Equity, you should be investing in equity. And then this is yield ratio on the right hand side. This part, this is yield ratio. Yield ratio is basically, what is the ratio of government security yield to earnings yield. On this also, we have dipped below the average. So if you look at the Nifty or Sensex or the bigger indices, if you look at large cap, clearly it is pointing to a scenario that you should start investing in equity now. The market is becoming attractive. If that, so that is one part I wanted to share with you. And we don't know where the market will bottom, whether it's 22,000 or 22,500 or 21,500. Trying to guess that is not going to help. You should just have, when we learn physics in school, we learn about vectors, and we are told vectors have magnitude and direction.
Yes.
In the stock market, I've learned that as long as you know the direction, that's enough. You don't need to get into focusing on the magnitude of movement. So directionally now we know, I don't know where the market will bottom, but directionally we know that we are below long-term averages, and directionally we know that we are getting into attractive zone. If the Nasdaq keeps falling, and if US market goes into a tailspin, there will be collateral damage. A lot of other markets will also decline in sympathy with the US. Even we might get caught up with that. But that is about the next month or two.
Correct.
Beyond that, we are already, even now we are at attractive levels. Because of US may fall, it will become more attractive.
Yes.
So between now and the next 3 months, one has to spread the investment and start entering, because it is becoming attractive for sure. Just my 2 bits on what you mentioned about small cap, mid cap, etc. If you ask me, small cap, we are always excited to invest. The reason that, let's say we manage AIFs, for instance. I mean, mutual fund, of course, the regulator dictates what is small cap. But say when we manage AIFs, there's no such strict definition. And all the ideation happens there. When you look at electronics manufacturing, when you look at, import replacement, when you look at exports, when you look at manufacturing, people making components for aircrafts. So many of these things are getting outsourced to India. So many small scale companies are becoming bigger and bigger, and winning orders, right? All of that ideation happens in the small cap, micro cap space. It's kind of a happy hunting ground for generating alpha. So always bullish on small cap, not because small cap will outperform large cap, but always bullish on small cap because that is where maximum ideation happens, and that is where long-term alpha really comes from.
Correct. So, in fact, it is almost conceptual that the small cap and below, universe is very thinly discovered as yet, right? And
There's a lot of, I mean, see, I always say we are in a country where, sev, bhujia, potato wafer wala, sabka IPO abhi aa raha hai.
Yes.
It's an undiscovered market. Market was broadly unorganized. You see hospitals, like today there was a news that one of the hospital chains, they bought up a big diagnostics company. Yes. I think Apollo. That is a sign of being organized. If you are in Mumbai and running a diagnostics chain, one of the 3 or 4 big diagnostics companies will try to come and buy you out. Why? Because they don't want any shops now. Everybody is becoming a chain. Why are hospitals becoming corporatized? They are becoming a chain.
Correct.
Right? So everything is moving from unorganized to organized. Everything is coming off scale. Everything is moving from unbranded to branded. Right? Let's take an example. I mentioned about these aircraft companies. India is one of the largest buyers for Boeing and Airbus both. One of the largest buyers of aircraft in the world is now India. Right? So those guys want to, obviously when we buy from them, we say that, boss, you have to source components from India. So there are many companies which are winning orders for, I'm not naming names. Recently, one company came with a QIP. Their job in life is to make engine components for Rolls-Royce. Rolls-Royce aircraft engines, engine components, some of them are made in India. Correct. So what I would say is that in small cap, and on a lighter note, the company doesn't know you're labeling it small cap. Yeah. It's just a nomenclature. But there's a lot of ideation which happens in small cap. In the last 2-3 years, small cap has gone up a lot. but that was small cap PSU, railway, defense, infra, energy, utilities. I don't think it was small cap IT or chemicals or
Correct.
consumer or something. Right?
Correct.
So it depends where you're doing the stock picking. It's a very vast universe. We have some 33 guys covering 950 companies. So it's a very vast universe.
Yeah, yeah, and that is where it absolutely makes sense when you call it a happy hunting ground. That is, if you have the prowess to do your research, which you clearly have in your team right now, that is going to be your strongest source of alpha going ahead, right? Because when you do bottom-up stock picking, you are taking a very, very calibrated and direct bet on a company that you want to invest in. There's no basket happening here. In fact, I've
Yeah.
always maintained the view small caps must not be called small caps as a basket, right? It is such a heterogeneous group of stocks that you must
Totally.
address it in bits and pieces, right? So
Yeah.
absolutely, absolutely correct, Ashish. I feel there's also if you're talking about investing, and if I have to ask this question on behalf of investors, most of them are now caught within a whirlwind of media debates around SIPs and the efficacy of SIPs. Should we pause SIPs? I feel ये थोड़ा counter intuitive हो जाता है because SIPs were introduced as a solution to such times, but now that has become a subject matter of question during such trying times.
Then you should time your SIPs.
No bigger paradox at this point. So
So
yeah,
see, in short, you cannot be. See, it's like this. Uh, Let us say that you are investing. So I'm just opening one slide just to share something. See, what happens is that we know that stock market behavior is like a sine wave. I'm just putting up one chart here. Just bear with me. Yeah.
yeah, yeah. Please.
Yeah, you can see this.
It's loading just a moment. Yes, we can see it.
Yeah. So, basically, anybody who studied physics or electrical engineering or whatever, they know the sine wave. This is how the alternating current or AC current actually moves.
Hmm.
There are crests and troughs and crests and troughs, correct?
Correct.
And this is a center line, which is a flat line.
Hmm.
Now, what happens is that why do you do SIP? You do SIP because you don't know, boss. Here, you don't know whether when it is here, you don't know it's the crest or is it heading towards the trough. When it is here, you don't know where is the crest. You
Hmm.
don't know whether it will go up and turn like this or will it turn from here. You don't know, right?
Correct.
Now, when it is falling, you don't know whether from here it is going to turn
Hmm.
or here it is going to turn or from here it is going to turn. So
Hmm.
this is why you do SIP, because you say, okay, boss, let's invest at every level.
Hmm.
Basically, if you invest at every level, at least you are hopefully going to be above average.
Correct.
So most people visualize the market like a series of crests and troughs, and it's difficult to time. That is why you do SIP. But
Hmm.
what is the beauty of the market? The beauty of the market is that yes, a sine wave is a good representation of stock market phenomena. There's
Hmm.
just one beautiful thing out here, which is that actually this center line is 45 degrees. It's not 0 degrees. See the difference between these two diagrams
Hmm. Yeah.
is this, right?
Influence drawing diagram. Hmm.
So people who follow technicals, they say that the market makes higher lows and higher highs.
Correct.
So because of the volatility, you do SIP, but at the same time, you know that over a long period of time, the market is only headed up.
Hmm.
Every time it makes a trough, we feel that okay, it will go down further. But
Correct.
basically, market makes higher highs and higher lows. So the thing is that these SIPs are done so that you enter at every level and you
Hmm.
don't you know get caught up with the timing. And मार्केट गिरने पे अगर एसआईपी बंद करने का था, मतलब कि 26,000 जब तक निफ्टी था तब तक एसआईपी चल रहा था, अब मार्केट गिरने लगा तो अभी बोल रहे एसआईपी बंद करने का है। तो
हाँ.
फायदा क्या हुआ? व्हाट इज द यूज ऑफ डूइंग, देन व्हाट इज द पॉइंट ऑफ डूइंग एसआईपी?
Correct. If nothing, averaging up was never a concept. It was always about averaging down. Correct. Absolutely. So, moving towards the end of this conversation, there is a very important request that I have. आशीष भाई, ये पिछले पोस्ट पैंडेमिक जो बैच आया है ना इन्वेस्टर्स का, उन्होंने पहली बार ये साइकिल देखा हुआ है. एंड आई वुड रिक्वेस्ट फॉर अ लॉट ऑफ एम्पैथी with what they're going through at this point in time. This is perhaps the first correction. I know you have said that हर साल ये होता है ऐसा, but इस बार ये काफी prolonged भी रहा है. It is probably prolonged for a very long time, this pain. Right. So, what is your advice to most investors out there? I know more seasoned investors are sitting tight; they understand. But this new breed, we have seen a large chunk of investors come in only in the past 5 years. So, what's
Hmm.
your action plan for them? What are the key actions or the key, mental attributes that they should implement while going through this phase of the cycle?
See, I think that, like I mentioned, one thing which is important, we said it right at the onset, which is that, volatility is a feature, not a bug.
Hmm.
Right? It's That's how the market behaves. There's nothing new which is happening right now. Second is, I think people who have come post-COVID, or younger people who have joined the market in recent past, I have said it multiple times before. I am very bullish on them. I think that their ability to take risk, their understanding, and you can see it in the data, by the way.
Hmm.
Uh, Only thing is that people who invest directly into equity, I personally feel that is being proven to be very risky. So if you
Hmm.
take in the last 6 months itself, Nirav, you analyze and research the whole market and so many funds and all. You
Hmm.
must have seen that if you take a diversified fund from the peak, it must have been down anywhere in the range of 10 to 20%.
Correct. Yes.
Uh, but if you take stocks, see what
Hmm.
happens when people are direct investors in equity. What
Hmm.
happens is that when you invest directly into equity, unless you are a deep researcher yourself,
Hmm.
or unless you are a contrarian at heart, that
Hmm.
you stay away from the herd.
Hmm.
Barring this, when you invest directly, you are most likely to have whatever is hot in the market will be there in your portfolio.
Hmm.
So last
Hmm.
3 to 4 years, what has happened is that all these cyclical stuff was hot in the market, defense, railway, infrastructure,
Hmm.
PSU.
Hmm.
And this is what is there in people's portfolios. And that is
Hmm.
what gave a lot of return. And now that is what is down 40-50%. So
Correct.
direct people who have invested directly into stocks, I feel that their portfolios would be anywhere between 40 to 50% down by now,
Correct.
maybe 50%, not lower. Especially the ones who have not been contra in their last 3-4 years. If you have been buying HDFC Bank and Bajaj Finance, then salute to you because you are really a contrarian.
Hmm.
Most likely, people have been buying all the hot stuff, and you can see the number
Correct.
of shareholders for each of these companies, and you can see what is happening. The fact that it is falling the most means it is in everybody's portfolios, and that is what people are selling. Correct.
Yes. True.
So I think that the damage is more in direct investing. People who are
Hmm.
investing in mutual funds, 15%, 20% fall in a diversified fund. It takes, I mean, if you ask me 1 year from now, you would have made up. You will be in positive zone. That's my personal expectation. And I think these are the times to show conviction. See,
Hmm.
people are very confident when portfolios are booming,
Hmm.
but from there the market turns downwards.
Hmm.
And people are very, very low on confidence when the portfolios are down. But that is the time to invest. The
Correct.
unfortunate part in markets is that the level of confidence you have has nothing to do with how much return you will make in the future. In fact, when you feel very, very confident, from there on, you're going to make poor returns.
Hmm.
And when you feel very, very underconfident, from there on, you are going to make great returns. So you have
Correct.
to invest when you are low on confidence. Very difficult, very counterintuitive, but this is not a maths exam. This is an
Yes.
exam for your gut and your psychology. So when the
Correct.
exam is not for maths, when the exam is for gut and psychology, you have to invest when you're low on confidence.
Correct. I feel that is quite a contrarian advice. We don't get to hear it, but it makes total sense, right? I also recollect this entire thing that you put out on Twitter or X. Let's call it microblog, right? Like you like to call it, on around how direct investing has led to quite a downdraft in investor portfolios. In fact, a lot of investors are reaching out to us seeking help on their direct stock portfolios. I totally concur with what you have said. I feel the ones who have been investing more systematically through mutual funds are much
Yeah.
happier at this point in time, at least vis-a-vis the carnage.
And see, nothing against direct investing, but if you are a direct investor, either you have to be a researcher or you have
Yes.
to be a contrarian.
Correct.
Either you research yourself, the least you can do is stay away from the herd. But see,
Hmm.
last 2 3 years, the herd has gone into all the cyclical stuff, and that is what is 50% down.
Yes, yes, yes. So I feel it's easier said than done, guys. One note for you: either invest in yourself, be a deep researcher, or develop skills to be a contrarian, or you always have an easier option to rely on highly seasoned and credible teams like the one at WhiteOak, and just outsource the gray matter work to people who are doing it for a living and are by far highly credible at what they do. So, Ashish, that brings us towards a close of this conversation. I feel, as always, it has been super, super insightful. I personally had a lot many takeaways right from the FPI charts to the entire valuation explanation that you shared. I feel there are wonderful nuggets that we can implement in our own perspectives as well. So, thanks a lot, Ashish. You have been kind enough to share your perspectives and lend us your time.
Thank you. Thanks for inviting me. Thank you, Nirav.
Thank you, Ashish.
Bye.
Bye. So, guys, thank you. This was the end of today's session, but we will get back with many much more interesting conversation, more interesting guests as well, very soon to discuss the most pressing pain points of an average Indian investor. So, stay tuned and let us know in the comments what did you think about this conversation. Who would you like to see next on the show, and what are the perspectives that you would like us to pick in whatever's next in this series. So, thank you guys for tuning in. It has been a wonderful conversation. Please do rewatch the entire video. Even if you are tuned in live, it is only going to help to rewatch it again. And this time around, sit with a paper and pen because there's a lot that you can directly implement into your investing strategy. So, with that, I'll see you around, guys, really soon with yet another interesting episode of the Fisdom Wealthcast. Meanwhile, happy investing, sit tight, and have faith.